Hi, this is Michael Neuenschwander with Outlook Wealth Advisors, CPA as well as Certified Financial Planner. Today we're going to dig into a little bit about Social Security, specifically 3 myths about Social Security you want to make sure that you're informed about. So myth number 1 on filings for Social Security early says, well, if I file for Social Security early and I have more money coming in the door, does that mean I can just spend more? It says some people, that's sort of the misconception. They say, well, in retirement, I'm going to be more active. I want to do more stuff when I'm early in retirement than when I'm in my late 70s or 80s. So if I get Social Security coming in the door, I feel like I have more freedom to take advantage and do things. Now, here's where this gets a little tricky, because in concept, that might actually be accurate. But here's the catch. As they say, devil's in the details. It doesn't mean you can actually spend more throughout your life. It means you need to shift your spending. So if that was your concept of saying, well, we want to have more money coming in the door, more freedom early in retirement, you need to be disciplined to understand that that early money in retirement is temporary. That's not money you can get accustomed to living at a higher lifestyle and then continue that forever, because by taking Social Security earlier, you have, in fact, taken a lesser amount, which means you'll have to rely more and more on your own investments down the road. And if you continue to spend at that higher level, you may put yourself in a bad position in the long run, sometimes without even knowing it, unless you've really done the research and run the numbers to see if it makes sense. So in starting Social Security early because you want to spend more of it, you can do that provided you go into it knowing that spending is temporary. Is it we're going to spend another 10 years of our retirement doing some traveling, but then we're definitely going to cut it out and tail it back. But the other danger of that strategy, you may plan on cutting spending later down the road, but what happens if something unexpected comes up? Whether it be long-term care, other expenses, you may not necessarily have control over. So going in and simply starting Social Security early so you can spend more is often the mistake. So to recap myth number 1, simply this idea that if you start Social Security early, you can spend more money early in retirement. It's just, if you really have a set plan that shows you can curtail that spending after just a few years, and you've addressed emergencies or the unexpected like long-term care or other things that may come up, maybe you can make that work. But for most people, going into retirement, starting Social Security early simply to spend more money without a definitive plan on what that looks like in the long run may be a big mistake. So let's talk about myth number 2. It says, well, I can simply file early and I can invest it better than Social Security can. And again, here's where maybe there's a little truth to this, but people get caught up in that idea and make poor decisions. So if we looked and said, as we mentioned, Social Security supposedly grows at 8%, for every year that you delay. So on the very simple basis, well, if I can invest and earn better than 8%, I should come out way ahead of Social Security. First, that's not really a valid conclusion. I'll share Social Security doesn't actually grow at 8%. If we think of it this way, we all have a finite expiration date. We just don't know when it is. Part of the reason Social Security goes up at 8% is because that's a year or 2 or 3 that they're not having to pay you anything. So 8% isn't a real number when it comes to Social Security, but also the idea that I can just easily take the money and invest it better than Social Security. If we look at rates of return, what has the market done the last 10, 15 years? And certainly, if we look at a 15-year number, the S&P has had a double-digit rate of return. It says, well, great, I'll just take that money, invest it better myself in the long run. The problem with that notion is most people, one, shouldn't be 100% in the S&P 500, but the other part that is buried in those good market averages is along the way, you would have had to endure at least twice where you lost 40% of that money. And when you're in a position in retirement, when you are taking distributions and needing to take money in order to have the lifestyle you want, simply you're not able to sustain a 40% decline in your assets and still make it work for the long run. So simply the idea of taking Social Security early, not because you need it, just because you're going to take it and invest it, typically is a wrong answer. Now, more times than not, when you get to the final month or two, is okay, I was planning on taking it at 68. But you know what? I'm going to take it at 67 in a couple of months. I'm going to get that 3 or 4 thousand a month coming in, 1 or 2 months early. That sometimes comes down to that personal decision. If you had expenses, other things where you could really use that last, 10 or 12,000 bucks, that's where we see the differences don't make as big of a long-term difference. Meaning, it's not a question of should I start Social Security years early because I think I can invest it better? But if it comes down, should I start it a couple of months early to get that last, three, four, $10,000 in because I have something I'm actually going to use it on? That's where we can see it may work in your favor. But investing and beating better than 8% with very limited risk is a little harder than it actually seems. So now let's tackle our third myth. This idea Social Security is going broke. And so, sometimes we visit with people, it's like, well, I better go ahead and get it because it's not going to be there. And when you read the numbers on Social Security, if you get your statement, it'll say right there in black and white that approximately mid 2030s, 2035, 2037, that Social Security is only going to take in enough to pay out approximately 75-80% of the benefits they've promised to pay. So that has some people thinking, well, either one, are they going to just cut benefits on people down the road? Or two, I better go ahead and take mine early because they may not be there. Now, this is obviously a political hot potato. And so there's lots of ways that Social Security can be adjusted or that it can be sort of fixed or prolonged. One of the big ones right now, of course, is Social Security taxes. Largely Social Security taxes come from people that are still working, but they cut off at about $160,000 of income. So to give you an example, somebody is earning $1 million, they're only paying into Social Security on the first $160,000 of that. Now, to be fair, on the other side, Social Security is calculated based on only about that same 160,000, so they don't get to count their whole $1 million of income into what kind of benefit they're going to get. But the bigger problem is simply demographics. That when we look today and say, there's a whole lot fewer people paying into Social Security compared to the people collecting it than there was, 2-3 generations ago. And so it's not a problem that happened overnight, and it's not going to be a problem that all of a sudden comes to a head, here in another, 10, 11 years. So when we look at it and say, well, how is it likely to be fixed, or what does that mean for you in terms of your decisions about Social Security? It says, more than likely down the road, some of the things that were already proposed, they'll likely have some sort of means testing when it comes to Social Security. So if we put that in perspective, a topic today isn't all about Medicare, but if many of you have studied that at all, based on your income, you can pay more for Medicare than your neighbor, than your friend. It's a sliding scale. Well, there's been talk of doing the same kind of things for Social Security. To say, well, based on the amount you have built up in your retirement assets or based on your income, is there some threshold where they may begin to reduce your Social Security? That has been talked about. Congress has discussed it. It is not law. So by no means am I trying to imply that that's what's happening around the corner. But if we have to look and say, how do we fix this problem? That's one of them. One of the other issues, as we said, is, well, they cut off that Social Security tax at $160,000. So if you were still working for another 10, 15 years, yeah, it's a high likelihood that they're going to continue to tax more and more of your income for Social Security. But if you're already retired, you're on the doorstep of retirement, that kind of becomes a non-issue for you unless you're planning on still having either self-employment or a business owner, during your Social Security years. When we look though and say, so those are a couple things that are going on. What else may happen? The other way they prolong Social Security for younger people, they simply push that Social Security age out farther and farther. Right now, as we've already discussed, early Social Security can be 62. Full retirement age for most people is around 66 and several months to 67. Late Social Security is 70. There's already been discussion of making early Social Security much closer to 64, 65. making full Social Security 68, 69, and so forth. Those kind of shifts simply preserve the Social Security bucket, if you will, and make it last longer. So for most people, if you're on the doorstep of collecting Social Security, you don't need to worry about that they're all of a sudden going to pull the rug out from underneath you. Like, you'll get largely what you've been expected and promised to get, but it's not going to keep up with inflation. This is one of the other big things where they can play with Social Security. And we know, we had a few years where there's some pretty significant Social Security increases based on inflation, 8%, almost 6%, but the long-term average has typically been around 2.5%. And for those of you familiar with Medicare, they take Medicare premiums out of your Social Security before you even see it. So the real number, if Social Security goes up, typically Medicare premiums go up too. So our estimates, and we're talking with clients in terms of how much should we expect Social Security to go up, is much closer to a net 1.5 by the time you account for that Medicare premium. So the big part when you think about Social Security and should you run out and get it early because you're worried about the system, says you've got to make sure that if you're going to start it early, it's not going to keep up with inflation. So do you have enough assets? Do you have a plan and strategy in place where ultimately over time, Social Security may end up being less and less of your overall retirement income? But simply to run out and start it early based on the idea that you think it's going to fall apart or go away, I'd say that's definitely a myth. You need to do more analysis and see what really makes sense for your overall retirement plan. And that, honestly, is the key to Social Security. When we've looked at both some reasons to start early and some myths about the system, there is no perfect answer for everyone. It really is an answer that comes down to what does your specific family picture look like? What are your finances, your investments, as well as your spending? And are there strategies, if you're married, between spouses where it can leave you better off? So now we've covered 3 retirement myths. The idea that you can simply take the money early and spend more, the idea that you can take it early and simply invest it better for the long run, and also we've addressed the idea that Social Security is simply going to fall apart. Hopefully, now that we've debunked those 3 myths, we've put you in a better place for making informed decisions about Social Security and about your retirement in general. So if this is the kind of information that's been helpful to you, be sure to subscribe below and join us for future videos where we talk about other financial topics just like this.